Do you find sales tax and all of its rules confusing? Well, you're not alone. It might seem straightforward in certain ways, but when it comes to sales tax, it is important to start at the foundation and also address common misconceptions. Let's break it down into three parts. First, what is sales tax? Sales tax is technically called a consumption tax. Now, at a high level, this basically means that this tax is paid by the end customer when they buy, aka consume, a product or service that is taxable. Now, as a business, you don't actually pay sales tax yourself. You collect it on behalf of the state and then remit it to the state at a later date. One key point that is important to always remember: sales tax is never to be considered business revenue. Now, it may hit your bank account, but that money does not belong to you, it belongs to the state. You're essentially acting as a trustee for those funds by collecting and forwarding those dollars to the right tax authority. One common big misconception about sales tax is that it is something that the IRS manages, and that is 100% false. There is no federal sales tax in the United States. Instead, sales tax exists at the state level and sometimes even at the local level, such as a county or a city tax, depending upon where you do business. More on this in a minute. Each state runs its own tax system through its Department of Revenue, which is sometimes called the Department of Taxation or the Comptroller's Office. These agencies decide what's taxable, what is not taxable, and how often businesses must file and remit taxes. So instead of one national rulebook, think of it as 48 different states, each with their own rules, rates, and filing requirements. By the way, I mentioned 48 different taxing entities because 4 states do not have a statewide sales tax at all: New Hampshire, Delaware, Oregon, and Montana. So if you include Puerto Rico and the District of Columbia, who do have an applicable tax, you get 48. In most states, the total sales tax rate your customer pays is made up of several layers. There's usually a state tax and sometimes a county and city taxes added on top. But some states keep things simple. For example, Connecticut has a single statewide sales tax rate, but other states such as Texas, California have complex combinations that vary from one city to the next. For example, if you sell a product to a customer who lives in Chicago, Illinois, that sale could include 3 layers of tax: the Illinois state tax, the Cook County tax rate, and the City of Chicago tax rate. The customer just sees one total tax amount at checkout, but on the back end, it's your job to make sure those amounts are reported and remitted correctly to each jurisdiction. Most of the time, especially for remote sellers, this is easy because you will remit those taxes on a single return to the state, and they'll handle the distribution of funds. Other times, though, in Colorado, for example, it's not quite as cut and dry. For sellers with a physical location in the state, the individual home rule jurisdictions actually collect taxes directly from the taxpayers. Now that we have some basics understood, how do you determine which tax rate to charge? This process is commonly referred to as sourcing, and there are 2 types: destination and origin sourcing. Most states follow destination-based sourcing. That means the sales tax rate you charge is based on where the product is shipped to. For example, your business is in Colorado, but you ship an order to a customer in Kansas. The tax rate you charge and the department you remit this tax to are both based on the customer's location in Kansas, not Colorado, where your business exists. That said, there are a few states who use origin-based sourcing for sales within their own borders. We'll address this in more detail in a future video, but the key thing to understand is this: the vast majority of the time you will use destination sourcing when determining the tax rate. Hey, if you're finding this video helpful so far, be sure to like and subscribe for more sales tax related content. Finally, number 3, before you start collecting any sales tax, you must first register within the states within which you are selling. That means applying for a sales tax permit or license through the state's Department of Revenue. Once approved, you'll receive an account number and instructions for how and when to file your returns. This part is extremely important. Never collect sales tax unless you're officially registered to do so. Continuing without a permit is a huge red flag, and you can get into serious trouble. If you discover that you've accidentally collected sales tax without being registered, don't panic, just act quickly. Get registered as soon as possible, report what you collected, and remit it to the state. The important thing is to get the collected funds off of your books as quickly as possible. And once you've registered, here's how the sales tax process typically works at a high level. You sell a taxable product or service, you charge the correct tax rate based on the customer's ship-to location, aka their destination, you collect that sales tax at checkout, you hold the collected tax in trust, making sure that these dollars are separate from your business income. You file a return and remit those funds to the proper state and local agencies. How often you file your returns, whether it's monthly, quarterly, or annually, will usually depend on your sales volume. Larger businesses tend to file more frequently, while smaller ones might only file once a quarter or maybe once a year. But there is one other detail you must understand when it comes to sales tax, and this might be the most important of them all. And for more information on that, check out this video. And remember, when you're not sure what to do, always consult with a sales tax professional.